What's up, everybody? Gen X Dividend Investor here. If you could go back in time and talk to your younger self about investing, what would you say? Would you change everything you did, or would you just suggest a few small tweaks? Well, a subscriber of mine recently posed a question like that to me, so I thought it'd be an interesting video to make. Specifically, someone named Max watched a recent video I made called How Much My $3.3 Million Dividend Portfolio Makes Per Year, and he thought that my portfolio with its 28 tickers was complicated, and so wondered what I'd change if I wanted to simplify things while still retaining most of the upside I had. That got me thinking about a slightly different question, which is what I would change if I could go back in time. And just to keep it real, I'll assume I can't name specific tickers I'd change, as that'd be too easy. I mean, this exercise would be silly if I just told my younger self to put everything in NVIDIA, as that gained over 300,000% since it came out, which is an astonishing compound annual growth rate of around 40% per year, making it the best performing S&P 500 company, even though it IPO'd years after I started investing. Or like I could say, put everything in a new digital asset called Bitcoin in 2009, and it will deliver about 100% annualized return for the next 15-ish years. However, if I could go back, there are two stocks I'd definitely tell my younger self to buy, especially since I came close to picking them up at the time. One of them is Walmart. When I got into investing, I told my dad about it and he suggested Walmart stock, but I was more focused on tech at the time and decided to pass, which turned out to be a definite miss. The other one was Google. I remember talking to a relative back in 2004 or so when Google was about to IPO, and I had a strong sense it would be an awesome investment, but I was still dealing with the sting of the dot-com crash and was kind of avoiding adding more tech, so I didn't go for it. Live and learn. Another mistake I've made more than once is holding off on buying a stock I really liked because I thought it was too expensive, and then I ended up just sitting on the sidelines while it kept going up. Like that happened with Apple. I didn't get in after the iPhone came out like I wanted to, but at least I eventually finally did. That experience, like a lot of others, taught me that hesitation can sometimes be just as costly as making a bad investment. Now you might wonder why I've not gotten into Walmart or Google over the years, and the answer is that something else always came up. But stepping back from investing for a moment, there's something even more important that often gets overlooked. The first thing I tell my younger self is to truly value and prioritize health. All of those cliche sayings about health being the most important thing are absolutely true. The ability to breathe easily, see clearly, move freely, speak, and live without pain is a gift we often overlook. Most people only appreciate it when it begins to fade or when they witness someone else struggling with theirs. Next, I'd move into the investing stuff and say how awesome it was that I began right after graduating and landing my first full-time job. I mean, that one decision, which seemed pretty innocuous at the time, set everything in motion. It was because I started investing and never stopped that I ultimately was able to retire in my 40s once my quality dividend income grew larger than my family's expenses. I've experienced firsthand how small investments into decent assets held over multiple decades compound into a good amount of wealth. I've seen that no matter how bad the markets get, you ideally just got to keep investing. The people who are constantly selling and then trying to buy back in almost always do worse than those who just buy good stuff and then buy even more good stuff. Think of your investments as real businesses you own. So if you've done your homework, would you really want to keep selling and jumping into the next thing? I'd also tell my younger self that it was smart to avoid bad debt and to always pay off credit cards in full, which I did. And of course it's smart to not have too much lifestyle inflation. I'd tell him that while the journey will have its tough moments, they're all things he'll get through, so try not to stress too much. I'd let him know that I've never been happier in life than I am right now in the future, and a big part of that is thanks to the true freedom of time that passive income has provided. I'd also say it was wise not to chase yield for its own sake, and that staying committed to quality investments truly made the difference over time. I'd explain how in the future I'm very grateful not to have to go to a 9-to-5 job anymore, and it's as awesome as I used to dream it would be, and that I often lie in bed before I fall asleep and reflect on how thankful I am that I started investing and never quit. One thing I would change in my portfolio, which is a mistake I made early on, was not paying attention to fees from mutual funds and ETFs in my work 401ks. I mean, I remember when I used to pick funds for my 401k, I'd barely glance through the various offerings without really understanding the expenses, let alone what tickers were in each fund. So I'd tell my younger self to put more effort into researching work 401k options. An even bigger thing I'd change in my portfolio would be to not go so heavy into unproven tech stocks before the dot-com crash. You see, as I got more into investing in the 90s, I started an investment club with some friends, and we focused heavily on new tech stocks since the new internet was upon us. But when the dot-com crash hit, 2 of the 4 members ended up quitting investing entirely because our collective portfolio was hit much harder than the overall market. Back then, you'd see a company put up a basic website and then their stock would shoot up as they'd start calling themselves an internet company, even though they literally did almost nothing on the web. So instead, I wish we'd gone heavier into S&P 500 dividend stocks. I did invest in many of the stocks I own today, but too much of my weighting went into newly IPO'd, unproven tech companies that were irrationally skyrocketing during the early internet boom. And just to be clear, a company paying dividends doesn't automatically make it better, but it usually means that it's been around for a while and has some proven staying power. Established dividend companies might not offer the same growth potential as younger ones, but they tend to be more stable. So what you do depends on your goals and risk tolerances and such. If you're young, then taking on riskier, unproven growth investments can make more sense because you have more time to recover if something goes south. Regardless, a key change I'd make to my portfolio would have been to diversify it more. I just had too many eggs in the technology sector because that's where all the action was at the time, combined with that's where my interest and expertise was. But when my portfolio fell a lot more than the market dropped, I learned about the risk of overweighting one sector. Of course, that also means I had fast up, but faster down. The whole experience really helped me understand why holding some nice boring stocks across multiple sectors often allows you to hold up better in rough markets. Anyway, fortunately I didn't quit investing, but one regret I have is that I scaled back how much I was investing for a while. That's definitely something I would go back and tell my younger self to handle differently. I mean, seeing my portfolio drop so sharply was really hard to take, and it shook me enough that I eased off for a while. Until that point, the market seemed almost like a casino where I couldn't lose. So going all in and almost losing it all for the first time was kinda sucky, to put it mildly. But I kept investing, just not with the same intensity as before. I remember briefly thinking that maybe the stock market was just too risky, and that perhaps I should consider something safer like CDs, because the market had shown me who the boss was, and it wasn't me. Later on, I realized that when you get overconfident with investing is often when the market humbles you the most. I really think that if YouTube had existed back then, I would have handled market crashes much better. But I had no one to turn to or really to talk about other than the two remaining guys in the investment club. None of my relatives invested in stocks, so I was kind of flying blind. I was on an internet stock forum, but imagine being on something like Wall Street Bets when the markets are crashing. Bottom line, I wish I could go back and tell my younger self to quit trying to get rich quick and instead just focus on quality. Doing that would have allowed me to grow my portfolio a lot bigger because established companies lost less, on average, during the dot-com crash. And it makes sense if you think about it. I mean, most companies in the S&P 500 are large, established businesses with stable cash flows. They often don't need to reinvest all profits for growth, and they've already captured much of their market share. Thus, they choose to return some profits to shareholders via dividends. Ultimately, the S&P 500 favors profitable, established companies which are large enough, have enough trading volume, and have a decent earnings history. Those sorts of requirements to be on the S&P 500 would have weeded out the overly risky dot-com stocks I often went into, which is why I'd have given my younger self the advice to just stick with S&P 500 tickers. Now, most people would probably tell their younger selves to just focus on broad market ETFs like SPY or VOO or whatever, and that would have performed better than my dot-com stocks, but putting that aside, I really enjoyed individual stocks, which still did well over the long run. Another big change I'd make to my dividend portfolio, if I could go back in time, would be to transition into a Roth from my traditional IRA. I wasn't even aware of Roths for many years after they first came out, which originally was around 1997, and when I finally found out about them, I made the mistake of just sticking with my existing retirement account. I actually started a Roth with only a few $1,000s in it, but it felt so small that I made the mistake of thinking it wasn't worth the effort and decided to just stick with my much larger existing retirement account. So I closed that initial Roth down and then didn't start a new one until many years later, where I just opened it and put a buck in it to get the clock started. Anyway, back then I didn't even know that you could do Roth conversions, and the amount of info available on the net was weak compared to what we have today. These days I figure I still might do a Roth conversion if I come into some cash, which is part of the reason why I don't do a 72T. Moving on, another thing I'd tell my younger self to do differently for my portfolio would be to do more research on a company before pressing that buy button, kind of like I need to do more research on ETFs. Back in the 90s, I didn't dig as deep as I do now, partly because the information wasn't as available as it is now, and partly because I was still relatively new to investing. Now, a major change I'd make to my dividend portfolio if I could go back in time would be to not pull back so much on financial stocks after the 2008 banking crash. That was the point when the collapse of the subprime mortgage market triggered the worst financial crisis since the Great Depression, causing widespread devastation across markets and economies. Major institutions like Lehman Brothers failed, while others, such as Bear Stearns, AIG, and Citigroup, required emergency bailouts or rush takeovers to survive. The value of financial stocks plunged, with the S&P 500 financial sector falling over 80% at its worst. Government intervention, including the $700 billion TARP program and aggressive action by the Federal Reserve, helped stabilize the system. The whole crisis exposed deep flaws in risk management and regulation, leading to sweeping reforms like the Dodd-Frank Act in the years that followed. But seeing my financial tickers get nailed and being disgusted by banks and such needing bailouts to survive and being too big to fail, or whatever, caused me to mostly walk away from the financial sector. Today it's only about 5% of my dividend portfolio, but I should probably be at 10% or 12% or something like that. So I'd tell my younger self that major market crashes aren't just numbers on a screen. They test your resolve, your strategy, and your willingness to stay invested. And instead of running from financials, I should have run towards the quality stocks. I mean, the best time to invest is when things crash, even though that's also often the hardest time. Right now, I only hold Goldman Sachs and Travelers in the financial sector, though I'm guessing I'll get back into JPM at some point down the road. Well, I guess I actually have more financials than that, since I also own SCHD. Anyway, speaking of Goldman Sachs, I was looking at their website today when I saw the following charts. Check out the middle one on Goldman's consistent dividend growth. It doesn't look like their dividends kept going up because they didn't correctly depict their dividend increasing in 2020 over 2019, even though I know they did increase it. So I wrote to their investor relations team this week and said, I'm a long-term GS shareholder and want to offer a small suggestion regarding one of the charts on your IR page. Your current dividend chart displays a quarterly dividend per share, which shows $1.25 for both 2019 and 2020. This may give the impression that there was no dividend increase in 2020, even though the annual dividend per share did increase, reflecting Goldman Sachs' commitment to consistent dividend growth. To better highlight this track record, I suggest modifying the chart to display the total annual dividend per share declared each year instead. This would provide a clearer and more accurate representation of your dividend growth over time. So bottom line, I'm guessing that someone at Goldman Sachs Marketing used quarterly dividend payouts in that graph, not annual ones, and that's why the graph doesn't look like their dividend kept going up, even though it did. Okay, moving on. A key point I'd reinforce with my younger self is that embracing short-term discomfort for long-term gain is the right path to remain on. The more short-term money sacrifices you make, the more you can pump into your investments, which means your wealth and ability to become financially independent should also improve. So eat out less so that your portfolio can eat more. Maybe buy a used car rather than a new car and invest the difference. That being said, one big thing I splurged on was a new BMW M3 in my early 30s, and then spent even more to get a custom paint job, aftermarket wheels, aftermarket exhaust, and stuff like that. And sometimes I reflect on if that was a mistake. I mean, I really enjoyed having it, and I feel like it's good to sometimes splurge, but was that too much? I could have really pressed the accelerator down on my investments if I hadn't spent that cash. Leave me a comment and tell me if you think it was okay to waste that much cash on a sports car, or if I should have invested more. Also leave me a comment telling me what you'd change in your portfolio if you could go back in time. Do you wish you had invested more when you were younger? Perhaps you wish you had started sooner. I know that a lot of people wait to invest until they have more money and until times are perfect, but what some don't realize is that starting is what makes things perfect. I mean, there'll always be reasons not to invest. Maybe the market feels too risky. Maybe it seems like you don't have enough to make it worthwhile. Or maybe you're just too busy and plan to get to it later when you're older. Now, there are valid reasons not to invest, like if you have too much debt, but make sure you're not making up reasons to put investing off. Waiting for perfect conditions often just means never starting at all. That reminds me of this weekend where I got a comment from someone wondering if it was better to not invest right now because the market's so risky given all the war stuff going on. I can't answer that for you, but in my experience there'll always be crazy things going on in the world, and I think you'll do better in the long run if you just keep investing in decent stuff at decent prices, regardless of wars, pandemics, alien invasion, AI singularities, or whatever. So don't fear the storm, just learn to dance in the rain. There are too many things in life that'll try to stop you from achieving your goals, so lean into the wind and keep going. And don't get discouraged if someone seems to be in a better spot than you are. Like when you're at the gym, you can find someone in better shape than you, but don't forget that there are people out there who die to be in your exact position, whether that's your financial position or your health position. And with that, I'd like to close things off and ask you to do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click the bell notification. Now I'd like to shout out my newest Patreon aristocrats, so my first thank you goes out to Demetrius. And then I'd like to thank Tosh for also signing up. Now, as a way to show my gratitude to people who leave really nice comments, I'm going to give a shout out to 10 subscribers who've done just that. So thank yous go out to Lister Bliss, Investments with John, Blue Collar Bullion Baller 4269, Hey What's Up 006, Stephen Tidwell 9036, Utro League Te, Apizu Cola Booster, then multiple nice comments from Jan Marsh 8299, multiple from Norfolk Paul, and multiple from Arthur Malonis 7985. Thanks folks, I really appreciate it. Now I'd like to recommend that folks check out my Seeking Alpha affiliate link, which has a sale running for a few more days where premium membership is $60 off, which I think is a great deal. Next, I'll pitch my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Patreon page, and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.